Hello and welcome. While the Nifty is dancing at record highs, everyone is busy chasing the same old IT and bank stocks. But listen carefully. There is a silent storm brewing in the shipyards of our country. We are looking at a specific defense PSU that has been quietly giving massive returns to those savvy investors who spotted it early. This isn't just a small pump and dump. We are talking about a structural shift in how India builds its naval power. The stock has doubled in value in a very short span, leaving the blue chips behind. Is this the multi-bagger opportunity you've been waiting for, or is the ship about to sail? Let us deep dive into the numbers and the story behind this defense giant, only in today's special feature. So why is this happening now? The secret lies in the Aatmanirbhar Bharat mission. The government has put a strict ban on importing hundreds of defense items, which means our local shipbuilders are getting all the paisa and the orders. The Ministry of Defense has set a massive target for indigenization. Earlier, we used to look at foreign players for our frigates and corvettes, but today, Make in India is the real deal. This policy shift has created a massive moat for companies like Cochin Shipyard and Mazatlan Dock. With the defense budget getting a solid hike every year, these companies are sitting on a goldmine of opportunities. It is a full-on structural play for the next decade. Let's talk about the specific script that is making waves, Cochin Shipyard Limited. It is not just any shipyard, it is the one that built our very own indigenous aircraft carrier, the INS Vikrant. That is a huge badge of honor, Bhai. This company has a unique mix of ship construction and ship repair. While construction brings in the big-ticket revenue, the repair segment is a high-margin business that keeps the cash flow steady even during lean periods. They are expanding their capacity with a new dry dock and an international ship repair facility. These are not just plans on paper. The execution is happening at a cracking pace, making them a formidable player in the global maritime map. Now, let's get into the MOTA numbers. If you look at the quarterly results, the PAT, profit after tax, has been showing a very healthy trend. The EBITDA margins are quite robust for a PSU, often crossing the 18 to 20% mark. This shows the company has great control over its operational costs. Their debt-to-equity ratio is very comfortable, which is a rare thing for such capital-intensive industries. When you look at the top-line growth, it's clear that the execution of existing orders is speeding up. For an investor, these are green flags. It's not just about the hype. The balance sheet is actually backing up the stock price rally. This is what we call a high-quality growth story. The most important thing for any shipyard is the order book, and boy, is it looking good. Cochin Shipyard is sitting on an order book of over 22,000 crore rupees. That gives them revenue visibility for the next 3 to 4 years easily. They have orders for next-generation missile vessels and even international orders from European clients for electric ships. This diversification is key. They aren't just dependent on the Indian Navy, they are becoming a global player. When you have such a massive pipeline, the market starts to value the stock at a premium. The order-to-bill ratio is looking very solid, which gives us confidence in their future earnings. What sets this company apart is their technological dell. They aren't just building basic boats, they are venturing into high-end green technology and autonomous vessels. With the world moving towards net zero, Cochin Shipyard's focus on hydrogen-fueled ships and electric ferries is a masterstroke. This gives them an edge in the export market. Plus, their capability to handle stealth frigates and sophisticated submarines is top-notch. They are investing heavily in R&D and digital twins to reduce construction time. In the world of defense, time is money, and being faster than the competition means more orders and higher margins. They are truly going global from the shores of Kerala. Now, don't just go and put all your eggs in one basket. We must look at the risks too. In the defense sector, project delays are quite common. If a project gets stuck, it can block a lot of working capital. Also, since most of their business comes from the government, any change in defense procurement policy or a cut in the budget could be a dampener. The stock has run up a lot, so the valuations are no longer cheap. There might be some profit booking or time correction in the near future. It is important to wait for the right entry point rather than jumping in at the peak. Always do your own due diligence before investing your hard-earned money. To wrap it up, the defense story in India is just getting started. This shipbuilder is a prime beneficiary of a massive national movement. With a solid order book, improving financials, and a push into green tech, the long-term outlook remains very positive. If you are a long-term investor with a horizon of 3 to 5 years, this could still have a lot of steam left. However, keep an eye on the quarterly numbers and any policy changes. If the stock dips, it might offer a great buy-on-dips opportunity for your portfolio. What do you think? Is this shipbuilder part of your Aatmanirbhar portfolio already? Do let us know in the comments below. Cheers!